Are you looking for a loan but getting overwhelmed with all the types and acronyms? I'm Erica Parker, Queen of Real Estate, and I'm here with Paul Lamnatos with Blink Lending. And Paul and I have been making videos over the last few weeks for homebuyers to educate themselves on the loan process and their loan options. And so today, Paul is going to be regaling us with all the different types of loans, the conventionals, FHAs, VA loans, and any other types of loans that he wants to throw in there to educate us on. So this one is going to be a little bit longer, guys, but we really want you to be educated on all of your options so that you can go forth and be awesome in your home buying experience. So take it away, Paul.
Oh, awesome. Yeah, all the alphabet loans, right? FHA, VA, USDA, conventional, Fannie, Freddie, like what does it all mean, right?
Yeah.
So you're looking at buying a house and considering what are the best financing options, right? And before knowing what the best financing options are, you kind of want to know what are the options out there overall. So as a loan officer, my favorite loan of all is the VA loan. It is my favorite because it's the best loan for the consumer. So VA, why it's the best? You get 100% financing, and you don't have a monthly mortgage insurance fee, and you get the lowest of the lowest interest rates. So it's like a trifecta, or if you're a hockey player, it's a hat trick. Again, no down payment, 100% financing, no monthly mortgage insurance, and the lowest rates of them all. So FHA rates are slightly higher than VA rates. Conventional rates are slightly higher than FHA rates. So of the three, VA rates are the absolute best. Now, after the VA loan, I'm going to skip a few of the acronyms and go into conventional finance. Now, with conventional financing, you can kind of divide it up. Conventional, rest of the financing we'll talk about. Think of government financing and then conventional financing. Your government financing is where all those acronyms, the alphabet loans we were talking about, are going to fall under. So your VA loan falls under the government category. We'll talk about FHA falling under the government category, and the same with USDA under the government category. Before we get into that, let's stay on the conventional topic. Now, why is a conventional loan my second favorite? Biggest reason is it doesn't have a monthly mortgage insurance requirement for the life of the loan. It also doesn't come with a monthly mortgage insurance requirement regardless of down payment. And it also doesn't come with an upfront mortgage insurance premium that's financed into your loan amount. So with a conventional mortgage, these loans are 30-year fixed interest rate loans. They could be an 8-year fixed interest rate loan. They could be an adjustable interest rate loan. They could be a fixed interest rate anywhere between 8 to 30 years. So you're really able to customize this loan type. It also allows for the lowest down payment, 3% on conventional financing if you are a first-time home buyer. So Erica, if you were to go buy another house right now within a 3-year period of you owning the home that you live in, you'd have to put down a minimum of 5%. But for you first-time homebuyers out there, it's as little as 3%. So you may have heard this whole 20% myth. It's exactly that. It's a myth, and it's likely still in 2020 the biggest myth in our industry. So with as little as 3% down, you can purchase a house with conventional financing as a first-time homebuyer. Now, my third favorite loan is an FHA loan. Why I like FHA loans is they're amazing loans. They really are. They're just not as good as a conventional loan. They're not as good as a VA loan. Now, why not? Well, regardless of the down payment, you're going to have a monthly mortgage insurance premium. So you could put down 20% on a 30-year loan, and you're going to have a monthly mortgage insurance premium, which means an additional payment on top of your pre-existing principal and interest payment, as well as your taxes and insurance. So think of it as literally an extra cost to your monthly mortgage payment, and the only reason it's there is insurance in case you default on your loan. So anyone that has an FHA mortgage, post the past few years, you're paying a monthly mortgage insurance for the life of that loan that just goes into a little piggy bank. Should people with FHA mortgages default, this goes to help offset some of those losses. So if you're someone that's like, why would I pay mortgage insurance for the life of the loan? That doesn't make sense. I agree with you. Let's go to conventional financing. Now, why does FHA financing exist if conventional is so much better? Well, there's some rules conventional financing has that FHA doesn't. For example, FHA is a little more liberal and forgiving if you have late payments, or if you have previous collections or charge-offs, or if you have a lower credit score. You know, if your credit score is in the 620, 630, 640 range, it's likely an FHA loan is better for you. If your credit score is in the 660, 680, and definitely over 700, you likely want to look at a conventional loan. Other things conventional FHA financing offers is a higher qualifying thresholds, meaning you can make less money and qualify for a house easier than you would for a conventional loan. Now, the life of the loan mortgage insurance, Erica, isn't just the only downside to the FHA loan. You actually pay an upfront mortgage insurance premium. So FHA requires you put a minimum of 3.5% down. And so let's pretend you're buying a $100,000 house, and here you're going to put 3.5% down. That means $3,500, right? So your loan balance, you would think, would be $96,500. $3,500 subtract from $100,000 gives you $96,500 left over. Except with FHA financing, you pay, and the pay, it just gets rolled into your loan, a 1.75% upfront mortgage insurance premium. So all those numbers said another way, half of your down payment gets rolled back into your loan. So instead of you starting out with a loan amount of $96,500, your loan balance actually starts out at $98,250, if my math is correct. If it's not, please forgive me. Just that amount, that $1,750 above the $96,000, you are going to pay thousands in interest to get that loan balance back down to the $96,500. So Erica warned you this one's going to be a little bit longer because it's so important, right? Now, a lot of times our industry is incentivized to steer clients, and that's a term that no one likes us using, in the direction of FHA loans. I say that to you to not just get you completely terrified, but to really verify if the mortgage company you're working with is giving you an FHA loan. Ask, say, hey, is there a reason that I'm getting an FHA loan as opposed to a conventional loan? So if you're someone that has good credit, good income, and good assets, you want a conventional mortgage. The last of the acronyms, until they come up with another one, is a USDA. USDA, Erica, as you know, this program came out quite a few years ago with the intention of incentivizing home ownership in rural areas, right? So if you want to buy out in the country, you can get 102% financing. So you get financed at 100%. Now that 2%, that's not, well, can I roll in closing costs? That's a fee that you pay. It's similar to the upfront mortgage insurance fee for FHA lending. But with USDA, it's just, they come out and say it's 102% financing, meaning your $100,000 loan starts at $102,000. So you literally start upside down, but it's okay if you intend on living in this property for 10, 15, 20 years, or you're someone that, you know, wants some chickens or some cows or some of that stuff, feel free to look into this loan. And if you want a normal house, look in your area and see if it qualifies for USDA financing, because we joke in our industry that it's chickens and cows, as I just mentioned, but you'd be shocked at how many homes qualify for USDA financing that have a mall right down the street from them. So you can simply go to Google USDA lending maps, and it'll pull up. And if you happen to look in an area that qualifies for it, talk to your mortgage company about it and just weigh out your options, right? I'm not saying if the house qualifies for USDA to jump on it. I'm not saying that, but weigh out your options, right? So Erica,
actually, I have like a quick question for you. Are you aware of anywhere around Houston, and this may be just a curveball for you, around the Houston area that actually does qualify that you've done a USDA loan for?
So a few years ago, a large part of Katy here in Houston had USDA. Conroe and Magnolia had USDA. And Conroe, I don't know if they still are, or you seem to get these lists that said they were the fastest growing city in America in 2019, right? So going up there and checking those two areas I remember did, but right now, no, you completely put me on the spot. So check the website and call Erica.
So I also have another question. You
Please.
mentioned that I guess you're incentivized, or some mortgagers or mortgage lenders are incentivized to suggest FHA loans over a conventional loan. Why would that be? Is that the government saying that, or is that a lender that wants that? I just was wondering, what is an FHA likely to give you a higher interest rate than like a conventional loan would? I mean, I just wanted to understand what the incentive is for them to suggest an FHA loan.
I'm so glad you brought up that interest rate part. I'm going to answer your question after I say this part. Okay. So I started with the VA loan, right, of having the best rates. You're going to find actually that FHA will have better rates than a conventional loan. Okay. So, well, Paul, why the heck would you tell me that conventional financing is your favorite if FHA offers lower rates? As a future homeowner, or as a current homeowner that's looking to buy another house, lowest interest rate is not what you want. What you want is the lowest payment, right? So although FHA offers a lower interest rate, it comes with what? Lifetime monthly mortgage insurance. So now when you're factoring, let's say, a 3.5% interest rate with mortgage insurance over the life of the loan, I may rather pay 4% interest rate, even though my principal reduction is not going to be as much. Maybe I can apply that monthly mortgage insurance funds to the principal to have it paid down. Of course, we would run a side-by-side comparison, but the FHA rate tends to be about 1/8 to 1/4 lower than conventional financing, but you're going to notice the APR is going to be higher because of all the fees that come with FHA financing that don't with conventional loans. Now, to answer the question of why would a mortgage company be incentivized, or what is the incentive? But the direct answer to the question, Erica, it's capitalism. FHA loans pay more. So when you're sitting here going, wait a minute, if I send a loan FHA, I'm going to make X amount. If I do it conventional, I'm going to make X amount. You can always refinance your FHA loan. That's what you'll hear. I get it. But why don't I qualify for a conventional loan? Is it due to my credit? So if you're someone with a 700 credit score, you have a W-2 paying job, and you have 3 to 5% saved. You don't have any previous collections. You don't have charge-offs, right? That's why you have a good credit score. I don't know of a reason why you would choose an FHA loan over a conventional loan. So that's the answer to the question, Erica. We as mortgage companies get paid more on FHA loans than conventional loans.
Gotcha. So just one additional question, because you threw out another acronym that my home buyers may not know. What is an APR?
APR, oh my God, an annual percentage rate. So APR is the true cost of your loan as an annual percentage rate. So your interest rate is actually what you make your monthly mortgage payment on. So your payment is based on your interest rate. Your APR has nothing to do with your mortgage payment other than it takes your interest rate into consideration in giving the APR number. So what else gets factored into that number on top of the interest rate? Closing costs. So if you're paying multiple lender fees to get a lower rate, or you're paying higher costs that are related with the loan, what you're going to notice is your APR is going to be higher than your note rate. Now, back up just a little. Your APR is always going to be higher than your note rate. But if it's ever 0.2 or 0.25%, 0.25 higher than your note rate, meaning your interest rate that you're making your monthly mortgage payment on is, let's say, 3.5. Your APR, if that's above a 3.7, you want to start digging and questioning the costs of it. Because it's very easy to say, we have 2% interest rates, and leave out the last part, which is, Andy, they come with $10,000 in costs. So in terms, mortgage lenders, it's always two numbers. It's interest rate, and then it's closing costs. Every now and then when there's mortgage insurance included, that's the third one there. But what's the rate I'm getting and how much is it costing me to get that rate? Those questions should be asked jointly.
Thank you so much, Paul. We really appreciate it. Thank you to all the home buyers who are tuning in. We really hope that this information helps you to ask your lender and to know what to ask your lender about the APR, the rates, the FHA, VA, conventional, USDA, so that all these acronyms aren't floating around in your head and not knowing what is going on. So hopefully you found this information helpful. If so, like it below and subscribe to Erica Parker now, and also subscribe to Blink Lending TV. They offer a great amount of education on your loan process and your lending options. So please subscribe to them as well. Thank you, Home Buying Nation, for tuning in. We'll see you soon.